and we'll be discussing more on how to like proceed with quantitative research. So the first session, we have 2 sessions today. So the first session will be on risk management. So we'll understand basics of risk management, and the second session will like look into how to do some, how to go into the field of quantitative research, do some research on your own, and I'll also share some resources at the end. Again, like today's topics are mostly theoretical, and will not go in depth in those topics, because those are like those topics are very involved and has some assumptions on our knowledge. So I'll not assume those and not go in depth. I'll like give some basic introduction to those topics and just move on. So yeah, before moving on with today's session, I would just like to ask if any one of you have any doubt regarding the past 4 sessions. So you can ask me now. If not, then we'll continue to this session. Okay, I don't think there are any questions. Okay, we'll start today's session. So it's the basics of risk management. Okay, so just like the other sessions, we'll start with the disclaimer. So this workshop is for educational purposes only, and none of this constitutes any trading advice or investment advice, and speakers are not responsible for losses incurred due to buying and selling of the securities, and like whatever taught here are just for fun and shouldn't be considered else. So the outline of the today's session, we'll start with types of risks, market risks. Okay, then we'll go to risk exposures. We'll look into hedging. We'll see portfolio construction, volatility scaling, bet sizing, and stop losses. Okay, so what are the types of market risks? So there are 2 main types of market risks. So one is called idiosyncratic or specific risk, and the other is systematic or market risks. So idiosyncratic risk is associated with holding a particular asset, like a single company stock, on which is known to have like that company specific risk. And this is like related to something called what you have heard of, like diversification, like don't put all your eggs in a single basket or something. So those kind of ideologies. So like this is the risk that is associated with a single asset. Suppose you buy that asset, or whatever the risk, if that asset drops, so that is due to like whatever the risk associated with that asset, like it drops or something. So it's idiosyncratic risk. Idiosyncratic risk can be also sector specific risk. So the sector specific risk are also idiosyncratic risk. So this is like if your portfolio has like assets from stocks from like a same sector, then you are bound to have like a high idiosyncratic risk or sector specific risk. So it can be mitigated by something called diversification, that is like reducing the exposure to a particular asset or a sector and transferring that to some uncorrelated assets or sector. So this diversification basically like saying your the components in your portfolio, the assets in your portfolio should be as uncorrelated as possible. So that is basically called diversification. Next is systematic risk. So this is the risk associated with the market itself. So it cannot be mitigated like using techniques like diversification, but some popular solutions with it are hedging. So systematic risk is related to market. Like if you have a portfolio, it's well diversified, but certain events like what happened during financial crash, those events happen and market crashes, then your like most of the assets in our portfolio will like bound to like tank because of like their individual correlation with the market. So individual stocks have correlations with the market itself, so they will like replicate whatever the market is doing, like if the market falls significantly. So this kind of to avoid this kind of situation, people usually use something called a hedge. So they hedge their positions using something like using derivatives like options or futures. So hedging provides a good downside protection. At the same time, it also limits the portfolio's upside. So hedging has some opportunity cost, because like to implement hedging, you need to pay premium from your side. That premium can be like on monthly basis or something. So you pay premium from your account, and in return you get that downside protection. So when the market is going up, you're still paying that premium, but although you don't have that downside risk. So that way, like, your overall upside potential also gets limited. But during downfall, it also gives you that good protection that you won't lose your entire portfolio. Okay, talking about market risks and systematic risks. So let's talk about risk exposure. So risk exposure is also known as beta exposure. It is how sensitive an asset or a portfolio is to the market movement. That is how it is dependent on the market movement. So if you see any asset can be decomposed this way. So if you see this is an asset of your choice, whatever asset, and let X be the benchmark or the market. So the return of your asset and return of the market can be like, equated this way. So it's some beta times the market returns plus some alpha. So alpha is some constant. So we'll talk about alpha. So alpha is what some people might be thinking it's the edge you have. Yeah, that's correct. So this is that alpha itself. And beta is like how much is the multiplier of the underlying market. So if the beta is more than 1, then like suppose your beta is 2, then if the market moves up by 1 point, your asset will move up by 2 points. So that's something like a scaling factor, beta. So if an asset of an orange portfolio have a high beta exposure, then it is like it will perform very well when the market is rising. So it is like acceptable. Consider like a beta of 1. So it's just your asset return times whatever times the market return. Asset return is equal to market return plus some constant. Okay, so constant is like something related to your asset itself. So when the market is performing well, you can see that your X is going up, then this is something constant, alpha is something constant, then your asset will also go up. So that is like clearly visible from this equation. But when your market is doing poorly, like market is giving you negative return, your asset will also give you negative return. So like things that will come to your mind, how to like remove this dependency on the market. So one thing that can be done like algebraically is like if I subtract beta X from both sides, then your asset will be purely dependent on like your return will be purely on the alpha. So if your alpha is positive, you'll get that consistent alpha every time. So that is called something like beta hedging. So we'll discuss that. To avoid market risk or systematic risk, we want our portfolio to have a negligible beta exposure to the market, which means the return on the portfolio will totally rely on alpha or other independent factors. So here I'm only considering alpha, but there can be also some independent factors. So those factors of an asset can be decomposed using something called a factor model. So this is something like I'll not go in depth because it's not in the scope of this workshop, but you can obviously read about factor models. Factor models are one of the very famous models, farmer friends model. So like 3-factor and 5-factor farmer friends. So you can read about that. So it's decomposes the return of an asset into like things like momentum and so on. So you can read about that. And also if you see you can have multiple beta. Suppose you have a portfolio, your portfolio return, you can like decompose your portfolio return into some other assets. Like if you want to see how your portfolio is dependent on Apple's return and SPY return, so you will get 2 betas. So each beta will tell how sensitive your return is to that asset return. So yeah, this is the market risk exposure. Okay, next is hedging. So hedging is as I've said, like on the first slide itself. So hedging is a way to mitigate the systematic risk. So it is like
I just had a small doubt here.
Yeah.
You can go to the previous slide.
Sure.
So the alpha with respect to individual security is the stock specific edge we have in the market, but we have the same alpha for the portfolio also. So we've not calculated alpha for each component of the each component security in the portfolio. So is this alpha in the second line the alpha for the whole portfolio per se?
Yeah, this is alpha for the entire portfolio. So it is constant, right? So it is constant. So if you want to decompose it to individual thing like alpha 1, alpha 2, alpha 2, you can do that. But ultimately, you can add up those alphas because alpha is a constant. So you can add up those. So this is a combined alpha of this portfolio.
Okay, so all the individual security specific are added as a one constant because they're all constant. So we just simplified it.
Portfolio need not necessarily have assets like stocks or something. It can be portfolio of multiple strategies. So you have n number of strategies. Each strategy has some alpha, and you want to make a portfolio of those strategies. Suppose you have a mean reversion momentum and so on. Like you have a cross section momentum. You combine those into meaningful portfolio, and then like you can make a something like this, like decompose the returns this way. So this is the combined alpha of whatever like you have in the portfolio.
Okay, that's a very interesting observation. I mean, earlier the classic portfolio theory of Markowitz, we study each portfolio as a classical amalgamation of only securities. But here in algo trading, we are saying even a strategy can be kind of an abstract object. So
right. It
has its own beta and its own alpha.
Yes.
That's a very good insightful call. Thank you.
Like portfolio, whatever you have, this is the return stream of our portfolio, entire portfolio. This is just combined return of whatever you're getting. So that's, you can decompose any returns to like whatever you want to like check the sensitivity, the beta against whatever asset you want. So the thing is that we want this beta to be like for the market as close to 0. So in next slide we'll be talking about that. Okay, so here we need to offset, as I've said previously, if we can offset that this beta x, then we can get something pure alpha. So how to do that? That is done by something called hedging. So usually it in markets you do it using derivatives, because derivatives provides that facility to do hedging and sorting. So hedging leads to returns which is purely alpha and independent of the market movement. Okay, so obviously like if you remove this market movement element, then it will be purely alpha. So but it will reduce the potential profit on the market is performing. You will lose the market performance, but you will have the strategy performance. Okay, suppose the market is going up, okay, then you might not get that performance of the market. Like whatever alpha is getting, you will get constant return of that. But if the market is like falling, then still you'll get that constant return. So that is the like beauty of hedging. But a caveat, there is a caveat with the calculation of beta. So that estimation of beta over time, it becomes like to stay hedged, perfectly hedged at every single point of time. It's just like really difficult, because the market is changing and your portfolio is also changing over time. So it's like you want to calculate the beta instantaneously. So calculating the beta instantaneously is it might be a problem, like if it is done manually, but if it's done algorithmically, then it's good. But executing that hedging position, like changing that amount of hedge. So if the beta changes from suppose 2 to like 1.5, then you need to reduce your hedge position. So since the beta reduces, you need to reduce your hedge position that way, that proportionally. But doing that often will require you to do frequent transactions, and that will accumulate transaction cost, and at some point transaction cost might get so high that it might lead to like losses overall. So this is the thing, like keeping a perfect beta neutral portfolio is difficult. So some strategies like pair trading are like inherently they are like hedged, beta hedged. So because there are two offsetting positions always, so you're maintaining, there is that hedge ratio. So it is always beta hedged. So this type of strategies are often called market neutral strategies. So it doesn't depend on the market returns. Okay, moving forward, we have a very crucial part of risk management called portfolio construction. So
I just wanted to understand intuitively how the market return strategy works, especially in base trade. So are we saying that when the market is performing well on the positive, on the upside, the stock which profits from a long position will give you the payoff, and when in a declining market, the Y stock which is more negatively inclined, which we have shorted, will start giving the payoff. Is that how it works?
Yeah. We have discussed the pairs trading thing, I think, on day 2. So yeah, on day 2, when we discussed trading strategies, we have discussed that. We have also like backtested the strategy, if you remember. So yeah, that is like, if you remember, we have discussed something about something called a hedge ratio, like doing a regression over the 2 asset. We'll find the common like multiplier of that X that gives Y. So yeah, that is the beta, and that way we have calculated the spread, but we have gone with the ratio way for simplicity. So you might have remembered that. So yeah.
Yes.
That is the thing. Okay, so portfolio construction is a way to mitigate the idiosyncratic risk by diversifying the specific risk among uncorrelated investments. So yeah, till now we have talked about systematic risk, how to mitigate systematic risk, but how to like mitigate the risk of idiosyncratic risk, so the specific risk. So it can be done through something called portfolio construction. So after we decide like what are the instruments we want to put in the portfolio, suppose we have maybe n assets, or we have n strategies, or we have a combination of strategies, assets, and like some other securities, or whatever, like we have some instruments to invest in and make a portfolio. Next, what we need to decide that how much money to allocate to each of this like return stream. So consider each of them as a return stream, how much money we need to allocate to each of them, and we need to assign them such a way that our risk is minimized and profit is maximized, or both has to happen. So this is some sort of like an optimization problem. Like we want to minimize something, maximize something. So this is like an optimization problem, and this is often known as portfolio optimization. The classic optimization method is like something called mean variance optimization, where the problem is to like minimize the risk subject to a return constraint. So what do I mean by return constraint? Return constraint, the constraint is that the portfolio must return more than a certain amount. So that is the constraint. So it must return more than a certain amount, but in that area, we have to find a portfolio that like the weights of the portfolio, I mean the money allocation. So money allocation, I'll refer to them as weights. So it's like between 0 and 1. 0 means 0% of the like overall budget is going to that return stream, and 1 means entire 100% is going to that. So I'll talk in terms of like between 0 and 1. So percentages kind of thing. So think it. Okay, so we need to assign weights to each of these return stream. So now we must make sure that there we can create like multiple portfolios out of them. Like we can iteratively assign some random weights to each of these return streams and get some random portfolios out of it. But we want to make a portfolio such that it gives, okay, consider like y-axis which is keeping track of the returns, and x-axis keeping track of the risk. So we have a return constraint. So return must be like above certain level. So if here is the like the level, and it must return above this. So in that region, like above that region, we have to find a portfolio that gives us the minimum risk. So we have to minimize that thing over that region. So that's a like a convex optimization. That's a convex optimization problem. So what is convex optimization? It's like a optimization problem that is discussed in mathematics. So I'll not go in depth into that. So you can read about it. What is convex optimization? Another very famous method is efficient frontier. So this is the classic Markowitz portfolio optimization. So it's like sort of a inverse kind of thing. If you could think like it finds the portfolio with maximum expected return at a specific risk level, which is represented by efficient front rate curve. So think same like axis, like y-axis gives you the return and x-axis is the risk. So now we fix the risk. And we find in that level, we find the portfolio that gives us the maximum return. So that is what the efficient front end does. So efficient front end is like a curve that is drawn out of all the portfolios that is like plotted. So yeah, you can read about this also, like efficient front end. I have linked the original paper in the reference. So this is about portfolio construction. Now comes volatility scaling. So realized volatility of an asset is like the standard deviation of the return. It is basically the measure of fluctuation in the return. So higher fluctuation will result in higher volatility, and similarly there will be higher uncertainty. So the idea of volatility scaling is to like maintain a constant volatility exposure by increasing or decreasing the amount of leverage on the asset. So what do you mean by leverage first? People here might not understand the word leverage. So leverage is like borrowing money like from the broker to like get a higher like position in some particular asset, get a like higher position in particular. Suppose like I'll give you an
Margin
answer.
trading?
Yeah, margin trading. Yeah, margin trading. It's like you have $100, and if you want to buy $100 a share worth of 100, there is a stock trading at $100, so you can buy one share of that. Now, if your broker provides you like 10x leverage, then now you can buy 10 shares of that, because now your $100 will be 10 times the. It will be 10 times, so it will be like 1,000. So now you can buy 10 shares of it. But as says, like leverage is a double-edged sword. So if like your stock drops by like $10, you lose your entire money of $100. But if it's like goes up by $10, then you will earn $100. Yeah. So basically double your money. So at the first place, if it would have gone like $10 up, then you would have made only $10. So just 10%. But if it would have gone $10 down, you just lose $10. So significantly lower risk and lower return, and leverage will give you high risk, higher return. Okay, if the volatility goes up, then he or she has to scale down the portfolio, that is reduce the leverage. Okay, reduce the leverage if the volatility is expected to go up. On the other hand, if the volatility is expected to go down, he or she should take more leverage, so that increase the leverage on the portfolio. So that way, like during less uncertainty, that means you take more risk and you can get you expected to get a better return. So volatility scaling depends on future expectation. So if you see here, like here are two portfolios that are plotted. The blue one is unscaled. It is not scaled by the volatility, and the orange is scaled by the volatility. And clearly there is an evidence shown that the orange performed better than blue. Both of them are same portfolio, just one is scaled by the volatility, one is not. And you can see the volatility of the entire portfolio. So how the returns are fluctuating of this portfolio. So the orange portfolio is fluctuating less than the blue. So you see here a huge spike, like volatility reached more than 30%, around 35%. So volatility scaling depends on, like as I've said, like it depends on expecting the volatility. So you need to have some sort of expectation of the realized volatility in some form of prediction of the future volatility. So a good model, like used in the industry is like something called GARCH. So that is the full form of that is general autoregressive conditional heteroscedasticity. So that is used for predicting the future volatility. So volatility is something that you can predict.
I just have a very native question here.
Yeah.
We say actually, the veterans usually say more money is made during volatile times, and when the market is flat, actually you don't make much money. So, given that, how is it that this volatility scaling is actually? It seems counterintuitive to me stating during more volatile times, we are actually reducing our exposure, and when the market is flat or less volatile, then we're putting in more money. So how is it that the returns on the left side, the orange one is showing more returns. On the right side, the orange one is showing less volatility. So with a lesser volatility, with a higher return, seems to be kind of a very impossible target to achieve. So what is making this volatility scaling work during low volatile times to make more money and high volatile times make less money?
Okay, so whatever I've said previously, money is made during volatile periods. So that whatever volatility you're talking about, if you see, volatility means your market is like, fluctuating, very like it's going up, going down, going up, going down, while it's swinging around. During that time, there is no clear trend. And during that, you obviously have some strategies that can make money. So especially mean reversion strategies work very well during those times. But strategies like momentum strategies, like they will get stopped out. Like if they have stop loss, I'll discuss about stop loss or what is stop loss later in this session. So if it moves wildly, if you think price is not going anywhere, it's just like fluctuating around some mean, but it is going very wild, like it's going up, down very wild. That is volatility. So volatility is standard deviation of return. So not a standard deviation, it measures the deviation from the mean, right? So that is it. So maybe what you're talking about is for mean reversion strategies, but mostly for momentum strategies, like volatility scaling is usually done, and it's done by the industry wide scale.
Okay. So this volatility is more specific to actually the price is not going in a one-way direction, not just going up again, coming down and reverting back to the mean, which means you end up going nowhere. It will only eat up your trade commissions and all that. So
yeah.
So it is more specific to the momentum strategy.
Yeah, momentum. Like whatever we're talking about, it's like the whatever volatility we were saying about, it's specific to like this quant finance. It's like realized volatility, and it's like calculated as a standard deviation of return or square root of variance. So that is the volatility. There is also one more type of volatility called implied volatility that is more related to like options. So that is a different kind of volatility.
I mean, that's given to us, and there's nothing we can do about it. Implied volatility.
Yeah. So okay, so for doing the volatility scaling, you need some form of prediction. So you need to predict the realized volatility. That is the caveat on it. Okay, so bet sizing. It is also a crucial part of risk management. So no matter how profitable your alpha, no matter how profitable alpha you design, if you don't have a betting strategy, then you'll surely lose money. So this is short thing. So bet sizing can be independent of strategies. That is, you can place some fixed bets regardless of the confidence of the signals that is generated by a strategy, or it can be based on the probability of the trade. Like what is the probability that your current trade will be a winner or current trade will work out. So higher the probability of trade, you'll do a bigger bet, and compared to like low probability trades. There is something called a dynamic bet sizing, which updates the bet size based on market condition and volatility. So again, this is like based on some sort of prediction. We'll discuss more on this dynamic bet sizing on like the second part of this session. So that is on introduction to quantitative finance. What is dynamic bet sizing, how it's done. It's mostly involves like prediction of some form of prediction of what's coming next, like some form of prediction in the future. So the intuition is somewhat similar to like volatility scaling, if you think. There is a very famous bet sizing strategy which is like used by practitioners. It's called Kelly criterion. It is very well known. It is developed by John Kelly at AT&T Bell Laboratories. So if you see here, this is the formula of John Kelly. So here W is the probability of winning. So this can be calculated by like looking at historical trades placed by those strategies, maybe the backtest, and calculate the winners versus the losers. Take the ratio and you'll get the probability of winning. and R is like total wins. This is the amount, the dollar amount or the rupee amount, whatever, by the rupee amount you lost or dollar amount you lost. So you get this R, and then you input those data in this formula and you get something called a Kelly percentage. So that much percentage of the entire account you want to bet, like that much percent of the entire budget you want to bet on that in the current trade. So this is what is calculated. So it has to be updated like after every trade, so to give the latest bet percentage. Okay, moving forward, we have stop losses. So no risk management class can be ended without like looking at stop losses. So stop losses is an order that's placed to avoid further loss when price reaches a specific level. It is used as a risk management measure that makes sure that the entire amount doesn't get emptied in a single bet. So if you see here, this is the price points. So these are the price points. So price maps here, you the trader executed the buy and he defined a stop loss somewhere here. Okay, somewhere here. As soon as the price reached at this level, it automatically like gets sold at the market price and he gets out of the trade. So he avoids the further loss. Like if the market keeps on going further, he would not be exposed to those risks and losses. So yeah, so that's what like stop loss does. It prevents losses, further losses. If stop loss level is not defined properly, it might lose its purpose and reduce the strategy's expected return. Yeah, or it can also like reduce expected return, especially like during mean reversion strategies. Like it's the opportunity cost that you are paying. So mean reversion strategies are like you're betting on the trend, and there might be certain, as I've said, like during volatile scenarios, like it might be often that your stop loss gets hit. So if you keep your stop loss level at like it doesn't define, you give a fixed stop loss level and the stop loss level may get hit soon and you will get exited out of your trade. So although like there might be a good trend ahead, but you're still getting exited at like very early, even at and that's also at loss. So it can happen that when a moment strategy has a like a narrow stop loss, it will often get triggered during high volatile period and trades might get exited sooner than expected. So whatever I've said, instead of a fixed stop loss, there is another kind of strategy of like dynamically adjusting the stop loss depending on the strategy's performance. This is also known as trailing stop loss, and as the strategy accumulates positive return, the stop loss level increases in some defined proportion. So here is an idea of the trailing stop loss or dynamic stop loss. So if you see the blue line is the dynamic stop loss. So I have kept, and the red is my strategy and purple is the market. So at this point, the market dropped, but the strategies get stopped out soon, like because of the stop loss, it got stopped out soon and it avoided this further loss. So this is the main use of stop loss. Okay, so we have come near to the end. So we have references. So the first hedging and the risk exposures was like most of the part was like had the reference of quantifying lectures. So you can go to this GitHub repo, you'll find the lectures on beta hedging. You'll also find the hedgings and risk exposures and everything. Like it's a very good repository. You should check it out. They have like multiple Jupyter notebooks, very well explained. The next four are books. So the first one is by Aldridge, Irene Aldridge. So it's a real-time risk. So it's not a very technical heavy read, but it's good like to get the basic understanding of what are the risks in market, especially in this age of data. So what are the risks involved? And the second book is on which I've like also mentioned previously on day 2. This is on algorithmic trading. So this is by Ernie Chan, Winning Strategies and the Rationals. And the third book is also by Annie Chen. This is Quantitative Trading, How to Build Your Own Algorithmic Trading Business. The fourth is a very recent book. So it covers the recent COVID crisis. So it's Strategic Risk Management, Design Portfolios and Managing Risks. It's by Camel Harvey and others. So it is out of a hedge fund called the Man HL. And the last is in this slide, the last one is a paper. This is the paper by the same authors of this book. So it's Strategic Risk Management out of sample evidence from COVID-19 equity sell-off. Again, we have the classic paper by Markowitz, Portfolio Selection. So you can check this. It was published at Journal of Finance in 1952. The next one is an open source implementation of critical line algorithm on portfolio optimization. So next two are like a bit more on the research side. So if you're inclined towards doing research, so you can read about this. So this is about like improving the Markowitz like critical line algorithm further using like quadratic optimizations and so on. So this is by Lopez de Prado and others. And final is by also Lopez de Prado. So it's tactical investment algorithms. So what I have said like on second or third slide, like about having a portfolio of algorithms or strategies. So this is about that, how to like tactically manage your investment algorithms and create portfolio out of it. So there is something called tactical asset allocation, but this is tactical investment algorithms. So yeah. Okay. So we're up to the Q&A. Any questions?
Just have a question as a practitioner's perspective.
Yeah.
You might be using a lot of algorithms yourself and come up with your own forte. My question is with respect to the shelf life of a typical algorithm. So if you come up with some algorithm which from your own understanding it's working currently, how long do you think can you successfully deploy it in the market? Is it 6 months, 1 year, 2 years? I mean, what's the average lifespan of a algorithm?
So that is alpha decay. So alpha decay depends on several factors. So the first will be like on, the complexity of a strategy. The more, so alpha decay mainly depends on like others having the same information as you. So if you have a very complex kind of strategy, it is less likely that others would come up with some same idea and implement the same strategy as yours. So it would have a like a very slower alpha decay compared to something that is very simple. That is like you saw something on a research paper and you just implemented it. You thought that research paper is very new. Nobody would implement that thing, but you have implemented it. But it would have a very like steep alpha decay, because like sooner that research paper will be public and people will start implementing that. And moreover, it's like simple to implement and it's not very complex. So yeah, then it can be easily replicated that way.
Which means to say that there's a lot of maintenance job we need to do, monitoring the expected alpha from the strategy and then tweaking it and coming up with new research. And so it's a continuous job.
Research is compulsory. Like you need to do a you need to continue research. You need to like find new alpha signals that are available. You need to do research on your side, like to keep updated with everything. Like there is something that is having a buzz in the market currently. There's like alternative data. So alternative data is getting very famous. So people are like mining those unstructured data, scraping the data of the web and like trying to find some alpha in that. Like people are also using, there are various like alternative data vendors that are coming up with various different sources of alternative data. So yeah, that depends on like there are also some vendors that have that makes a like specific contract with you, that once they sell that data to you, they won't sell the data to anyone else. And those kinds of things also happen. Yeah.
Which leads me to the next question. All good things in life must end. So we can't keep on eternally deploying algorithms and hope that it works. Just like we have the Star Wars, now we have the Algo Wars. So everybody's becoming cutting edge and a time comes when the system can't take anymore because it's all been exploited. So where are we heading? I mean, maybe it's still new, or not everybody has joined the war, but say 5 years, 6 years down the line, would we be still talking about algo trading and machine learning, or where do you think is the next green shoot or the next new kid on the block? Where are we heading?
I think we're already there. Like people are started exploring how to use quantum computers for like exploiting the markets. So already like people started developing some asset pricing model using like quantum computers. So there are quantum algorithms that are coming up. There are quantum machine learning that is coming up. So yeah, like as like I think the finance is the most finance is like continuing to use the most cutting edge technology that is available in the market, so to keep that edge. So I think regarding the alpha, so what I think is like there are a lot of like micro alpha still left for like still left unexplored, so that can be also like explored using like I think we don't have those kind of technologies yet to explore those areas. Like specifically, there are few interesting areas in machine learning where like people are trying to model the market as a whole. So they're trying to model like each participants in the market, and I think that is possible using quantum algorithms. So yeah, it is getting much complex day by day, and
it's sounding very scary, almost like the landscape in an alien movie.
right.
True. So what would be your advice for, say, people like us who are just individuals and we're not too ambitious, we don't want to lose, just make some money if we can? So what would be the advice for people who are just starting out at the individual?
Coming up with like a good trading strategy that can make you consistent profit is like, it involves various things, including luck. I think like it also involves some luck finding that good strategy. And moreover, like the easier way I think is to like get along the side where like which they're making, where they're making money. So specifically, like I mean joining those trading firms, joining those hedge funds, like utilizing your skills using that and using that technology. Because let's face the fact that we as an individual trader cannot match up with the technology and the research that they have, the R&D team they have. So why not like join them and like use our knowledge and combine their knowledge and make something bigger?
Yeah, it makes sense. I mean, join them, learn with them,
Yeah,
learn
join
from
them,
them.
learn them. Yeah, definitely.
You become big yourself, at least intellectually. Come out and then do your own things.
Right.
Makes sense. Good one. Thank you.
Okay, is there any more questions?
Hello.
Yeah, hello.
Yes, sir. Like, how much time it takes to get used to like this algo trading and all that adjustment? Because it's very well not normal to trade with algos. Like I am trading, but in India market, I do it manually.
Algo trading, first of all, like you need those prerequisites to get started with algo trading. So you need to have a good knowledge of like programming, and you need to have also the knowledge of statistics and mathematics behind like whatever algorithms there are. Like to even to read the research papers, you need those knowledge. So next I'll be talking about how to like start researching for trading strategies on your own, like venture into more into like quantitative research. So I'll be discussing that, and I'll be sharing some resources also, like maybe like that can help you to get started. So till now, whatever I have taught that like from day 2 to day 4, it was mostly a practical thing. Like I have shown you how to do that on your own, but you can go as complex as you want, and you can stay as simple as you want. So it's upon you how you want to do it. Like I believe that you should start from like very simple thing, and like uh get step by step ahead, like climb one step at a time.
Because right now I'm in like a foundational. I've just I will be starting statistics too, like from
Okay.
this term, and I have done Python. But I have to, so like, what should I do now? Like, how should I start now? Because I know Python, but statistics still remaining.
I think like you should wait till you get those knowledge of like at least basic level statistics. If you are still in hurry, I'd say that start reading that books on like introductory statistics. So
Yeah.
at least introductory informations are very important. Like okay, later things you can build on your own. Maybe like if you want, you know. To go in depth into some topic. Suppose you
Yeah.
come up with a research paper and you have there are some ideas related, some mathematical things are explained. You don't know about that. You can always like search about that. If you have the basics, you have the foundation strong, then you can obviously understand those high level mathematics. So yeah, that's the advice from my side. Okay, then if there are no further questions, then we'll be taking just a 2-minute break and we'll start with the next session on quantitative research. Just 2-minute break. I'll be back in 2
Yeah,
minutes,
sure.
like 48K. I think I lost the permission of co-host. Okay, so next session will begin. It will be on quantitative research. So I'm waiting for the co-host to post permission and to share the slides. Shankaran, hello. I don't think like host is present right now. So can you share the slides and like share the screen and show the slides? I will explain and there. Yeah, thank you. Not risk management one. Yeah, the quantitative finance one. Yeah. Do a slideshow. Okay, perfect. So this is about introduction to quantitative research. Next slide, please. Okay, first of all, the disclaimer again. So this workshop is for educational purposes only, and the speaker is not responsible for any losses incurred due to buying and selling of securities. So whatever doing is just for education purpose. So yeah, next slide, please. Okay, so the outline that we're looking for is first of all looking for ideas. So will how to like approach and how to think about ideas that can like specifically like how to think about like alphas, how to design alphas, where you'll get those ideas like designing alphas. So we'll look at that. Then the second is framing a research question. So I want to frame the right research question, and from there we will derive the hypothesis which you want to do further research on. Then on the research itself, we'll look how the research structure should be, and then we'll move on to like seeing further research. We need data. So data is the heart of quantitative research. So we'll look at how to collect the right data, and then we'll look at financial machine learning. So some key points of financial machine learning specifically, like I'll give just an overview, not any in-depth. And we'll look at some common pitfalls of quantitative research. So while doing research, what are the things that you need to avoid? And finally, we'll give you some useful resources for research. Next slide, please. Okay, finding ideas. the ways to get inspired for ideas is to read research papers, mostly academic. And if it's peer reviewed, then it's better. And second is peer reviewed journal and research articles. So here are some research papers libraries. You can go to SSRN, you can go to Archive, you can go to Repic, and you can search for like if you search for something specific like trading related to quantitative trading, quantitative strategies, quantitative research. So those will be there. Along with that, like specifically with SSRN, like it's you can like select the category like finance and see what are the papers available in that. You can see the latest papers. You can see paper with like highest number of citations and all those. So you can check that. Next is like journals. So few of the good journals are here I have mentioned. So Journal of Finance, Journal of Portfolio Management, Journal of Finance and Data Science, and there's one more, Journal of Algorithmic Trading. So I forgot to mention it here. So next is like subscribing to some newsletters like Paper Digest. So what Paper Digest does is like if you subscribe to like quantitative economics, quantitative finance, those topics, then whatever like recent papers that are uploaded to archive, those will be like sent to you as a newsletter daily. So that is what Paper Digest is. Then you can subscribe to Quantocracy. So Quantocracy will send you everything that's related to like quantitative finance and algorithmic trading in general. So it will be sent to directly to the email, like whatever happened on the day. Like this is also a daily newsletter. Okay, next slide, please. Next is framing the research question. So let me check if I. Okay, framing the research question is like first of all, what is a research question? Is a question that is used to frame the main hypothesis of your research. That question is like the answer that you're seeking for specifically. A good research question is key for doing quantitative research. Without a clear research question, the focus of your research might shift and may lead to anything like that is may not lead to anything that is like useful, or indeed may lead to some false discovery, which is more dangerous. A vague question must be avoided at all costs. Like if you have some questions like, does momentum strategy work? That is a very vague question, and that is not something specific. You can do like lots of things. Like when it comes to momentum strategy, lots of things comes to your mind. Okay, momentum strategy works in what? Works in what kind of market, and what kind of data? Like everything comes to your mind that's not clear. Like, so how a research question should be? Research question should be like very clear, precise, and provide the specific information to the reader to clearly understand it. Like this question, did cross-sectional momentum on top 10 equities by market cap over last 5 years outperform the market? So this is a question, like it has everything. Like it has the universe that you want to do research on. So the universe is top 10 equities by market cap, and you want to do the research over last 5 years, and the strategy that you are doing is cross-sectional momentum. So it is like not that specific, but not that vague. It's good enough. Okay, so this is how like you should frame a research question. So next is research structure. Yeah, next slide. Yeah. So if you see on the right side the flow chart, every quantitative research starts with something called like with good data. So you need good data for quantitative research. So data is from data like it goes into something called a universe selection model. So you have some database, okay, and from there like you want to do your research on some specific securities. So that is usually called as universe of stocks or universe of assets, whatever you want to call it. Then those securities goes through something called alpha discovery process. Like you discovered the alpha. So that is like on the first slide, whatever I've shown you, like you have read some research papers, you have got some ideas out of it, and you have like got some like alpha signals that you can like create. So you have created some alpha signals, maybe like you read some and research papers, and from there like you want to combine every like ideas you found there. So you have n alphas, and you have something called alpha combination model. So that is a model like that combines those n alphas. So this n alphas are combined. Like usually these kind of models like are sometime, you know, machine learning models. So usually this kind of are something machine learning models, and then those combined alpha is then fed into something called a portfolio construction model. So we have discussed portfolio construction previously. So portfolio construction takes a risk model, some constraints, and some objective functions. So constraints are like whatever I said, like the return constraint. So you said like I need minimum this much % of return, and the objective function would be like, okay, I want to maximize the return or minimize the risk. So those kind of things. It also has something called risk model. You can read about risk model. And then what you do is next you test that. So you have developed some idea, and you have combined those ideas. You have developed a portfolio out of those ideas, and now you test that, like test that portfolio. So this is now an iterative loop. So whatever you see in the the yellow region, so that is a iterative loop. So if that doesn't work out, you go to the step 1 of universe selection. Then you tweak your alphas, you combine your alphas, you do everything from the start again until like it works. So you need to follow some protocols, of course, like for keeping keeping the overfitting in check. Like you must make sure that your research doesn't overfit. Then whatever you if something works out of your like this research loop, then you move it forward to trade and you execute that portfolio. So yeah, like the alpha discovery process from like it combines ideas, various ideas in using a model, and then portfolios are constructed out of those alphas, and then finally you backtest that portfolio and keeping some backtesting protocol so that to avoid overfitting. So next slide, please. Okay, so we have talked about data. So data is the heart of quantitative research. So you can also call it the fuel that powers the quantitative model. So high quality data is very crucial for the success and doing quantitative research. So data can have missing values. It can have errors. Like errors usually occur during a recording that data point. So exchanges keeps on recording those trades and all. So there might be some error in recording, then that data point will be very erroneous. Then there can be fault in cleaning or issues with aggregation. So fault in cleaning, I mean like there can be some missing values, as I've said previously. Also there can be some missing values in the data, and by mistake if you do a backfill, then it will cause look ahead bias because you are using future information to fill the current information, fill the gap of current information. So at the current date, it is having the information that is not available at that point of time. So that can also happen. And issues with aggregation itself, like these are all that can, like there are data vendors who even data vendors can do this false too. Like there can be issues with aggregation. So like try to avoid the data sets like data sets like bar data sets which are aggregated by like some data vendors or something. Like if you want to do some serious research, then don't go with like those Yahoo data sets and all, whatever that is available, the bars that those are available. So let it be like a minute level or something data, but still like you don't know how it's aggregated, how the data is cleaned. Like those bars are generated from those stick data sets, right? Those trades, like whatever that have occurred in exchanges. So they have resampled it into like a 1 minute time period, and they have created those 1 minute bars. But you don't know how that data set is cleaned. There might be outliers, how the outliers are handled, and so on. Like, so avoid using those things if you want to do some serious research. Try to like get hand on some real tick data. It's better if you can get it directly from the exchange, but fine if you can get it from like some trusted source, like serious data vendors like Bloomberg or something. So yeah, there are like lots of good data vendors. And then like you might also need to look for something called survivor bias. So I have talked about survivorship bias on like during the time of backtesting. So yeah, on day 2, so I have talked about survivorship bias. So that is something you need to take care of during universe selection. So as I've said, what is survivorship bias is like suppose you want to, like, you have made a selection that you, whatever you'll do your research on, it will be on Nifty 50. So you will consider current constituents on Nifty 50, but you're doing like research for last 10 years. During last 10 years period, there must be few stocks like which have went bankrupt, and those are not in current constituents of Nifty 50. So then you are inducing some sort of a like bias, which is called survivorship bias, and like your returns must be over optimistic. So you must you are overestimating the return of your strategy that way. Okay, also low frequency data, you must beware of low frequency data, because whether maybe your strategy is very low frequency, it might have trade frequency of like trading only once a month, but if you backtest it on low frequency data, then you are missing out those details in the big data, whatever happening in the market. You will not get a very good backtest out of it. So your backtest will have a very narrow view basically. Next is like handling outliers. As I talked about, you don't know how those data vendors are handling outliers. So the outliers are always a nuisance, because like if data set there are outliers and you remove those data sets, then you are inducing a bias, because you're saying that okay, these data points never happen, but actually those happen. Those data points did happen, but you're removing it from the data set. Or if you keep those outliers in the data set, then your results will be, your analysis will be highly skewed, because those are very extreme values. Outliers are very extreme values. So your analysis will be skewed. So scientists use some methods like winsorization. So what winsorization is done is like keeping some quantile of that data and bringing those data points to that higher and lower quantiles. So that is like to keep to keep the analysis from getting skewed, like it avoids that skewness in the analysis. So winsorization is a technique. And second is like something called mean median imputation. So when that outlier occurs, so using previous mean or median, you bring the data point down to the mean or median. So that is mean median imputation. So there are several pros and cons of these strategies. So you must read about what are these. There are also some other methods of handling outliers. You can read about that. Like there are various research papers written on handling outliers in the data. Okay, finally, like I have attached some videos, so you can check these videos. These are on like how to get the right data, how to handle the data sets, and how to handle these problems in the data sets. So you can watch those. Next slide, please. Okay, financial machine learning. It's now about, let's go into like financial machine learning, financial data science kind of thing. So this is just an overview mainly. So whatever I'll be talking is mostly from a book called Advances in Financial Machine Learning. It's a very good book if you want to like really get to know what is like, or if you really want to know what is a financial, how machine learning is applied to financial markets. So that is a really good book. It has strategies and all those techniques. So it's a very good book. It has the codes and like it's explained very well. Okay, so first thing is preparing the data. So you have collected the data, you have cleaned it. Now you need to prepare the data such a way that you can apply some sort of a machine learning algorithm on it. Like usually there is tick data. Okay, you have tick data, you have cleaned those data, you have make sure like outliers are handled properly. Now you cannot feed those tick data directly to a machine learning model. So it's huge numbers of data. You must find a way to structure it down and compress those information. So usually that is done like using something called bars. Before that, like financial data comes in many shapes and forms. Like usually you'll find like it's classified into 4 types of data: mainly fundamental data, market data, financial analytics data, and alternate data. So you can see those things in this table. So fundamental data include this like asset, liability, sales data, macro variables. Whatever we're talking about, like price, volume, and all those comes under market data. Analytics comes under like analyst recommendations, credit ratings, to new sentiments, all those comes under analytics. And then finally, like we have mentioned a couple of times about alternative data. It includes satellite imagery, CCTV imagery, Google searches, like Twitter data, some metadata like scraping the Reddit and so on. Yeah, those are alternate data. Yeah, so as I've talked about, like for applying machine learning models, financial data need to be structured in a way to extract valuable information. For finance practitioners often tend to use table representation, often referred as bars. So here by bars, I think most of you have understood, like who have experience in finance, about those time bars, like as I've discussed previously also in day 3 and day 4. So it's not only the time bar, like time bar is like a minute bar, an hour bar, and 30 minutes bar, and daily bar. So that doesn't mean that it's restricted to only those. There are also some different types of bars which are not very like you may not see it like everywhere, but it's used for research and like for used by certain quantitative trading firms. So those are called tick bars, volume bars, dollar bars. So if you see on the plot on the right side, the red plot or some reddish orange kind of plot. So that is the time bar. So it's the returns that are plotted, and the dotted black line is the normal distribution. And tick bar, volume bar, and dollar bar, those are represented by cyan, blue, and purple. So if you see, those are like more closer to the normal distribution than the time bar. So that is the advantage of all those bars. They are like the statistical properties that they carry are better than time bars. So they're more suitable for machine learning. So yeah, you can see like time bars are most common, widely used, but there are certain bars called information driven bars. So I have not shown information driven bars here. So information driven bars also present. If you read the book or Advances in Financial Machine Learning, you can know more about them. So those are like imbalances. Those takes microstructures into account, like checks the imbalance and calculates, generates a bar based on that. So those have better statistical properties. Just because of that, we are using it in like financial machine learning. Next slide, please. Okay, now that we have like prepared our data set, in order to run some sort of like a machine learning algorithm, supervised learning algorithm, we need some sort of labels, like to say that we want to predict this for the future. So what do we want to predict? So we need to mention that. So that is usually done through labeling the data. So these labels has particular, usually like what we want is like these labels to have some particular view of the market, like either the direction of the market or the outcome of a bet usually. So why not forecast the market? Why not like the price? Why not label them with the future price? I'll say like what is the difficulty with forecasting price and why you should not venture into like forecasting the real the future price of any securities or assets. So it comes with different sense of problems. Okay, it's difficult to predict price due to the inherent nature of the market. So the assumption of machine learning algorithm on and what literature suggests is like is good to predict the direction of the market and the magnitude of the move separately rather than trying to predict the price. So that is the thing that this book also describes. So if you see on the right side, those you see the plot of the price. So on the x-axis there is time, on the y-axis there is price. On the first top image, plot, you see like there is like a dotted line on the top, dotted line on the middle, and dotted line on the bottom. So the top and the bottom are considered as horizontal barriers. So it's the upper barrier and lower barrier. Usually those should be like thought of as like take profit and stop loss. So if you would have invested at the vertical, whatever you see the red vertical line, if you would have invested at that point of time, whichever things hits first, you label according to that. If the stop loss hit first, so in the first image, the stop loss hits first, so you label it as -1, or maybe you label it with the negative return that it has generated from that point. Whatever negative return you have generated, you label it that way. There is also one more thing like finance practitioners usually do is like to think upon, like it's not that you will hold the position forever. Like if nothing of this like upper barrier or lower barrier, nothing of this is touched, then it's not that you will keep your position open for like infinite period of time. You will close at certain period of time. So that introduces something called a vertical barrier. So in the plot below, you see the vertical barrier at the end. So in this plot, price hits neither of the horizontal barrier, neither the take profit nor the stop loss, but it hits the time barrier first. So time is up. It says like you trade for only n number of days. If during n number of days nothing is generated, then you close the trade. So here the trade is closed because it has neither profit nor loss. So sorry, neither profit nor loss. It's not that. Like it's closed. It didn't hit any of the thing. Like neither it hit the take profit nor it hit the stop loss. So it is exited. So this method of labeling. Okay. So this last when it's hitting the vertical barrier, it is labeled as 0. So it's like don't enter the trade. So in future, it's labeled as like 0, so don't enter the trade. And if it hits the upper barrier, it means return is positive. So the label can be considered as 1. So maybe if your machine learning model gives you a prediction of 1, then you want to buy at that point. And if it gives -1, then you want to sell at that point. And if it gives 0, you want to do nothing. So this labeling method is called triple barrier method. It is a technique suggested by Dr. Lopez de Prado. So in that same book, Advantages in Finance and Machine Learning. So next slide, please.
Just a couple of questions on the previous slide.
Yeah. Previous slide, please.
I mean, especially the third point, the third point, it is difficult to predict the price due to inherent nature of the market. What we are advocated is either predict the magnitude or the direction and not both. I mean, my question is fundamentally, what is price then? Is price a function of both magnitude and direction? So it's just a magnitude into direction should be the price, right? Or the incremental price change, the delta. Price
also has one more thing. It has noise. So you're ignoring that. So it has direction, it has magnitude, this is noise.
Noise.
So noise. So noise is the nuisance. So noise is the thing that creates the difficulty for predicting the price. Yeah.
Okay. So because of the noise factor, we are not able to accurately predict the price.
Yeah, definitely. That is the thing.
I mean, stochastic calculus, Monte Carlo, all these methods, none of them are close enough to predict the price as of now.
Nothing can predict the price till now. Like you cannot predict the future price of anything very accurately. Like you cannot predict it.
By the very nature of the random nature of the
markets are very random. Like I'll explain. Like that is one of the common pitfall of quantitative research. I'll explain that is one of the point.
Okay, so then what is making the expert Marcus Lopez de Prado to say that bet on either the magnitude or the direction? So isn't there noise in that?
See, direction now the problem reduces significantly. Like before, the problem of predicting a price is very complex. Now predicting the direction, the complexity of the overall problem reduces significantly. Okay, so now it's just saying, okay, just say me either the price will be going up or price will be going down. So that is one model. So you can have a model which can like predict either the price is going up or down. So that is much simpler than saying, okay, what will be a price, what will be the next price, like, because now the problem you can think of it's like a classification problem. So in machine learning, it's a classification problem. So but if you want to predict the price, that would be a regression problem. And as I've said, like, it's very difficult to predict the price on its own. And
yeah, I mean, more
why the
factors in
complexity
price.
reduces, while predicting the direction, that is like that's base is related to something on the stochastic calculus, and like also related to the data generating process of the market. So yeah.
I mean, so this model then is much easier to, fit into the machine learning.
Yeah, it is easier. It is easier. Like it is easier because while if you're saying a machine learning model to predict the price, you're saying that predict the direction, predict the magnitude, and predict the noise. So you involve three problems in a single model, and it becomes for a very state-of-the-art model also to handle those three problems together. Like what it is suggested that handle one problem at a time. Like either you handle direction, either you handle direction separately, you handle magnitude separately, you handle noise separately, but still, like, it's very difficult to predict noise. Noise is like it's random. Noise is just random. Yeah, noise is just random.
Thanks. Thank you so much for clarifying. So this was something that was eluding me for quite a while. So I got it. Noise is what is not model. Okay.
Okay. Next comes to the modeling part. So modeling is crucial for performing proper modeling technique is very crucial to train whatever the data set you have created. So first we need machine learning algorithm to perform either regression or classification tasks. So whatever level the data previously, so it would be a regression task if we want to predict the magnitude, like magnitude of the return. So that'd be a regression task. And if you want to predict the direction, like it's going up, down, or it's staying flat, then it would be a classification task. So there will be three classes: 0, -1, and 1. So according to that, we need to select the machine learning algorithm. The goal of the machine learning model is like, sorry, not the machine learning model, the overall modeling process is to minimize the three sources of error that ML model generally suffers. So specifically the bias, variance, and noise. So this noise is different. This noise is related to like the data itself, whatever the data you're giving them. So it is related to the data itself, and it is at the same time reducing the bias and the variance. So bias is related to something called underfitting, and variance is what you know, like your model is like giving, like deviating too much away from like the predictions and all. So that is the variance. So you want to reduce all of these three errors. So that is the main goal of modeling. The method suggested in Advanced Financial Machine Learning by Lopez de Prado is to have a model to predict the size of the bet, which have a high recall and may have a relatively low precision. So you should not worry about precision for like finding the sites. So what are like recall and precision? I'm using some complex words, so these are like related to machine learning. So recall is basically like when is related to this confusion matrix, if you see. So I don't want to go much deep into this thing because it gets complex again. So think of a recall like it is giving away okay, suppose your model has three classes, right? Going up, down, or nothing. So if your model splits equally, splits equal prediction, like for up, down, and nothing, then it has a very high amount of recall. So it is giving you the output. Like it is not skewed to only single output. Like if your model only gives you like say only up, like model says every time it says like it will go up, it will go up, it will go up, then it has very low recall, and it might have some precision depending on the data set, but it has very poor recall. So at that point of time, you don't want to consider at the first model, you don't want to consider the precision thing. You want to have a very high recall. So there are specific ways to handle those recall, to have a high recall model. So you want to have that, and you have a second model which is called a meta model on top of the existing model. It is to basically correct those wrong predictions. So that model will correct the wrong prediction of your initial model, and it is like improving the precision of your existing model, so your underlying model. So that is the work of meta model. So just don't stress much on like this meta model and thing. Like if you don't know much about machine learning, then like first learn the terms of machine learning and then read this book, and you will understand for sure. Okay, so techniques like bagging is preferred over boosting. So these are some modeling techniques that are used. So bagging is like giving certain having a bagging mostly uses something called a tree-based model. So it has a tree-based model, and it will have it'll feed some data sets, and it will take the out of sample performance, and it will compare, and then it will optimize itself. But boosting, what it does, it takes the same data set, and it over and over it feeds into the model until the model becomes perfected. So mostly this is the next thing is important, because boosting tends to address the problem of underfitting. So but bagging addresses the problem of overfitting. So generally in finance, overfitting is an issue. So that's why like bagging is preferred over boosting. So underfitting is like you have these data points, values, but if your model just predicts like something like a linear thing, like a line you predicts, this is called underfitting. If your model is like fitting every data point perfectly, then it is overfitting. This is pure overfitting. But if your model fits just the right amount, then it's good to overfit. Like overfitting and underfitting can be decided using only out of sample data. So yeah. Okay, next slide, please. Okay, just a minute. Okay. Okay, finally we come to the use of machine learning in asset allocation. So small percentages of data content is signal. Like whatever you have the market data, whatever you have the data is small percentages of only very small percentage of that is like real information, and it's mostly suppressed by like arbitrage force, and most of like like 90% of them like the data set is noise, and only like maybe 10% of them are signals, and those signals are also like suppressed by arbitrage force. But ML techniques can help denoise those data, like especially the covariance matrix. So in portfolio optimization, portfolio construction, and like asset allocation, like you generally use something called a covariance matrix. So covariance matrix is like taking like creating a square matrix of all the assets you have and taking the covariance of that in the corresponding cells. So there's the covariance matrix, and ML techniques can help denoise that covariance matrix, and whatever the little signals is left, it helps to like amplify those signals. Denoising a covariance matrix can be useful in deriving nonlinear relationships, but linear relationships. But for nonlinear relationships between assets, clustering algorithms are used. So again, like ML techniques like clustering are used for deriving the nonlinear relationship between those assets. So it is useful like to find like in asset allocation, what we tend to do, we tend to like give correlated assets less weights and uncorrelated assets more weights. So there may not be a linear correlation. There might be a non-linear correlation, which can be like uncovered using something called clustering algorithms. Techniques like mean variance optimization are not stable due to its dependence on covariance metrics, which can be noisy, and ML methods can help correct that. ML-based asset allocation algorithm like HRP, which stands for hierarchical risk parity, shows evidence to outperform the classic benchmark algorithms like CLA, critical line algorithm by Markowitz. So yeah, machine learning is very useful in asset allocation also. Next slide, please. Okay, now coming to some common pitfalls of research. So the first thing is very crucial, like forecasting the market. Like market is a dynamic system. It changes its states depending on the supply and demand. Most of the statistical methods and machine learning techniques has the base assumption that the data is stationary, samples are IID, and form a normal distribution. Market data doesn't qualify a single requirement from all those trees. Although there are techniques which can like resolve those issues, but the dynamic nature of the market doesn't seem to be fit for forecasting. So what do I mean by stationarity? So if you see the below image, so you see that green plot, so that is a stationary series. And all the other red series are non-stationary. The first one is non-stationary because its mean is dependent on time. Mean is varying with the time. So mean of the series is varying with the time. This third one is that the variance is varying with the time. So it starts the very low variance, then the variance suddenly climbs up and it goes down. So this is also not stationary because of that. The third is not stationary because of the time dependent covariance. So as you can see, like the covariance is like wide, and then it gets narrowed, and then again it gets widened. So these three series are non-stationary, and first is stationary. The second pitfall is backtest for validation. Backtest shouldn't be considered as a research tool, rather a sanity check. So this is what I have told you on the second day while explaining backtesting. Like backtest is like a sanity check and sanity check of the theory, like the hypothesis you have framed. So, and it it must be used to it should not be used to develop theories. Like what you should do instead is like create a theory first, okay, develop a theory, and then either try to prove the theory or contradict the theory using like something called a feature importance analysis. So this is also a machine learning technique, like which is very robust to overfitting. So this is also mentioned in the same book. The third thing is like looking for all weather strategies. So try research, like researchers try to like find that holy grail strategy, which they think like it will work on all regimes. Like because that doesn't happen, because the likelihood of the first of all the likelihood of existence of such strategy is very slim, and discovery of that is like most likely to be a false positive. So rather scientists and researchers must focus on strategies that can perform optimally on the specific regime, like mean reversion or market sell-off or a trending market. So focus on something that is a regime specific strategy that is easier to come by. So it is easier to develop rather than like thinking of something that will work every time. So yeah, this is what you should focus on and try to avoid these pitfalls. Next slide, please. Okay, now coming to some useful resources for research. First is connected papers. So here, if you're reading research papers and if you want to see the connected papers associated with that research paper, just go to this website, type that research paper, and you will see all the papers that are connected to that research paper. And you can see a nice graph will be shown And by graph, I mean the graph in computer science and the graph theory. So nice graph will be shown, and there will be like edges, and there will be edge weights saying the how like this paper is linked to that paper and how common are they. So this is good for like looking at how that research paper was derived, like ideas of that research papers comes from. So it's good for researchers. The second is a course topics in mathematics with application in finance. This is by MIT OCW. So for those of you who want to learn the mathematics behind like mathematics that is used in finance, so you can go to this course and learn all the mathematics. Next we have Quant Connect. So Quant Connect is also a research platform. So whatever I have taught like on day 2, day 3, and day 4, so about backtesting, developing a live trading strategy, and deploying, all those three can be done in a single code. Like single code, I mean in a single algorithm. So you write one algorithm, and that same algorithm can be used for backtesting, same algorithm can be used for live market, same algorithm can be deployed with using their platform itself. So Quant Connect is like a kind of platform, so you can go to Quant Connect. Next we have quantresearch.org. So this is the website of Dr. Lopez de Prado. So very good website. It has lots of research papers and good contents. The third is like a compilation of various resources available for quantitative finance and economics and finance in general, like codes, research papers, podcasts, videos, data sets, everything. Like everything is compiled in this website. So ML Quant. Next, we have the GitHub of Quantopian. So you can go to this and get the GitHub of Quantopian. So the lecture series, you can check the lecture series and the research. And next we have Oxford Man Institute's publications website. So you can go here. This institute is like a joint work of Man HL and Oxford. So they have created this institute for specifically for quantitative finance and financial research. So you can check the publications here. Here is also like I have it JP Morgan's AI research. So you can go here and check JP Morgan's research. Next slide, please. Yeah, finally we come to the references. So first three are articles. So first is on best research practices for quantitative finance research. So you can check that. Whatever like first 2 or 3 slides I have taken from from this article, and the second and third articles are written by myself. So it's related to financial machine learning. So you can check those 2 as well. And next 3 are books. So first one is the book that I have used for explaining the financial machine learning. So Advances in Financial Machine Learning by Lopez de Prado. And the second one is also by Lopez de Prado, is Machine Learning for Asset Managers. The third one is for people who want to go in depth and understand the real math between like what's going on, why like you have asked those questions like why not to predict the price, why it's difficult, why like predicting the direction is easier, all the mathematics and mathematics related to the machine learning algorithms also. So everything is explained in this book, Machine Learning in Finance from Theory to Practice. This is by Matthew Dixon, Igor Halperin, and Paul Bilogan. The last is a paper. So this best practices in research for quantitative equity strategies. This is from Journal of Portfolio Management. This is by Frank Favosi and Peter Combe and others. So this is a very good research paper for understanding how to like what to keep in mind while doing quantitative research. So this is also like, you know, it also explains some pitfalls and other things like what are the best practices when it comes to data. Next slide, please. Okay, now few more references, actually research papers. So first is by Lopez de Prado again. So 7 reasons most machine learning funds fail. So This is one, and second one is also by Lopez Di Prado, Alex Lipton, and Alex Lipton. So it's 3 quant lessons from COVID-19. And the third one is also by Lopez Di Prado. It's backtesting. And the fourth one is also by Lopez Di Prado. So whatever I explained about quantitative meta strategies, so meta models. So if anyone wants to go in depth into that meta models, meta strategies, then can look at this paper. So this from this paper itself, the thing is derived. Okay, now we are up to the Q&A. Any questions? If no questions, then we'll explain the task for the day. Okay, next slide, please. Next slide. Okay, so since this is about research, so I want you to do something about implementing a research paper. So I've given you those sources where you can go and like search for research papers. So find a research paper, a simple research paper that you like. If you want, like you can, maybe I'll post some simple research papers soon, like I might email you, and try to implement those whatever is done in research. Try to implement the trading strategy, try to replicate the performance, try to get the same data if possible, and try to try to replicate that research paper and test the research paper in a Google Colab notebook or a Jupyter notebook, and make sure like to explain the strategy using the markdown cells. And also at the end, please mention the references if you have used, like the other research paper you have used and other references you have used. The last date is 25th of May, and this is the form submission form. And yeah, if you have any questions regarding the task, you can ask.
So you will be sharing those links for research paper where we will find out.
Yeah, if you want a research paper, like you couldn't find one, then you can contact me and like I can provide you with few options. So yeah, like basically like I want you to get the experience of implementing whatever is done in a research paper. So that is crucial for like doing research on your end actually. So if you want to develop a trading strategy of your own, it usually like happens like you have few ideas from multiple research papers and you combine them, and that might turn profitable. So yeah, like implementing research papers are also a part. Okay, so we are approaching to the end of this workshop. So we'll give a closing remark and we'll end the workshop. So let me share my screen. Okay, now I have the co-host permission. You can see my screen, right?
Yes.
Yes.
Thank you. Okay, so this is the end of this workshop on algorithmic trading and quantitative finance. It was a good 5-day workshop. So going forward, I want to give some recap what I've done. So on day 1, we had some basic understanding of financial markets and electronic exchanges. It's working, how order gets executed at exchanges and other venues. On day 2, we saw the advantage of systematic trading, backtesting a trading strategy using Python. On day 3, we implemented a trading strategy for live market scenarios, and we understood trading APIs and listening to market feeds. On day 4, we deployed the same trading strategy to live market, and we deployed it to the cloud and we monitored the trading strategy. On day 5, that is today, we learned some techniques of risk management, and then we proceeded with the quantitative research, how introduction to quantitative research and how to generate alpha. So okay, what is the roadmap that we're looking for? What will happen like after this workshop? So first of all, what I want to do is start a reading group. So this is what I have mentioned on the day first also. So I want to start a reading group. So what will be a reading group? Like every week we'll take an hour or two. We'll take a session of an hour or two where we'll have a discussion kind of thing. So we'll gather up. Mostly this will be on our Discord server. So we'll gather in the voice channel. So, and any one of you, like if you have read something interesting research papers, you can come and discuss those things. So like if I read something, I'll discuss mine. If you read something, you'll discuss yours. Maybe you found some interesting article, you can discuss those. So sort of like reading session and like discussion session. So that will be a reading group. Next on the roadmap will be to start a quant club. So quant club in this program. So when starting this is because like what I have in my mind is like to conduct some not workshop session but some separate sessions where I can invite some industry practitioners who can come and do sort of like a webinar. So I want to invite industry practitioners for a webinar. Also like we can get involved in something like a trading competition. So that is also something in my mind. And moving forward, we'll look forward to something like similar like this, like ATQ workshop version 2.0. So we'll be looking forward to another workshop. So that might be an advanced workshop. So yeah, let's see what you can do next. Okay, so special thanks to the POD team of IITM. Like without them hosting this workshop on Zoom wouldn't be possible, and special thanks to them. Like they gave the permission for the Zoom meeting, and like they also streamed it on their YouTube. So yeah, a very special thanks to POD team. Next, I'd like to thank Gagnit Kaur. So without her, like this workshop wouldn't be possible. Like she helped a lot in like hosting this workshop, administering the meetings, different meetings with sponsors and all those. So she worked really hard for this workshop. So yeah, really appreciate that. Similarly to Shashwat Sundar. So he is also part of like hosting this workshop. He gave me like advice regarding like how to conduct these workshops and all, like very valuable advice. So thanks to Shashwat Sundar. Next, Nikita Sharma. So whatever like designs you see, like the brochure, the poster, everything was created by her. So because of her, you're seeing those like designs available. So thanks to her too. And thanks to Indra Reddy and Shankaran Nambodri. So they are like the back end of this workshop. So whatever the support, whatever like the links you're seeing on the Zoom meeting and on the YouTube chat and everything, like they were constantly replying to you guys on the Discord server, even like regarding any issues. So a really special thanks to both of them. So moving forward, okay, so if you want to do any further discussions regarding algorithmic trading, quantitative finance, so please join this Discord server and we can discuss those things further. And also the reading group will be taking place in this Discord server itself. The link will be in the description and also in your chat. So thank you for attending this 5-day workshop on algorithmic trading and quantitative finance. Hope to see you in future workshops.
I mean, a special thanks and a good deed of gratitude to you for conducting such a authoritative workshop. Usually, we have this 1 hour or 2 hours webinars and people just skim through the surface. But for you to take 5 days time out and then conceptualize from scratch such a rigorous and difficult subject is algo trading. Really hats off to you. So, my personal debt of gratitude. And what I'm really excited about it is the roadmap. So this is not the end of it, rather it's just the beginning, like the reading club, the quant club, and further workshops, the industry practitioners coming in, doing their webinars. I mean, this is all exciting. So hope to stay in touch with you and learn a lot from you.
Definitely. I'll be looking forward to seeing you all in like future webinars, even in the reading group. So yeah.
Thanks. Thank you a lot.
So thank you everybody for joining. Hope you have good day, good night, whatever. Like, okay, bye.
Thank you.